profit we're making in Africa is 500 million rand a year. So this isn't just the politically correct thing to do. This is a serious generator of profit for us. And that trading margin that you can see again, and I'll cover that in a bit more detail. So those are the main countries where we do operate, and I've highlighted the ones where the big growth is happening, which is essentially Nigeria, Angola, Ethiopia, and we are busy entering Ghana as we speak. But we don't see ourselves everywhere in Africa. We don't see ourselves in the Arab part of Africa, and that's just to do with culture, and those economies really look north, they don't look south. Okay, key thing for us in terms of the strategy is that we start off with exports, obviously. It's the normal route that South African companies go. You export into the continent. You get to a certain size, and it's then a question of putting in the local manufacture. For us, we really do partner with the multinationals, and in a way it's easier for us. We don't have to go and develop a brand. We really do a deal with SAB or Heineken or Coca-Cola or Pepsi or BAT, whoever it is in place, before we'll put in a major investment. So if I give you an example of Angola, or pick any country, and we're going into Nigeria, we'll talk about a bit about that in terms of some beverage can investment. Before we conclude that deal, we will have concluded back-to-back supply agreements with the major players, the Heinekens, the SABs, the Cokes, the Pepsis, Diageos, and we will not go ahead with that deal until we've got those long-term supply contracts in place. And we did the same with BAT. Before we put in the cigarette carton operation into Ibadan, which is 130 kilometers north of Lagos, it's literally alongside BAT. We'll only do it if you give us a long-term supply contract. And the margins are guaranteed, pricing is guaranteed. We pass on any increase in raw material, and we pass on any decrease. So we protect our margins through the duration. Obviously, looking at it from their perspective, in almost every instance, we are replacing imports. So the cost of getting that product to Ibadan, say, or into Addis Ababa, it's just prohibitive. So we can actually get a better margin as a result of that, because we're way under the price that they're paying for imports. And that's really the dynamic, is that they're doing better. So our latest investment in Addis, for example, is a crate line. We have a back-to-back contract, long-term contract with Coca-Cola there. But those crates are being imported through Djibouti, if you're familiar with the geography of Africa, across this impossible road system, through multiple borders, to get it to the Coke factory in Addis. I mean, the price by the time you get it there is prohibitive. So as long as we're below that price, and we're way below that price, they'll give us a long-term contract. But clearly the price we get there is better than South Africa, because here or in Europe, they just put out a tender. 10 people put in their prices and they pick the lowest. So that's the dynamic effectively. So the key is we then partner with the multinationals, we lock in the long-term contracts, and then once we've done that, we look to broaden our range. So we've gone in, let's say, into Nigeria with BAT, and we're doing all their cigarette cartons. But once we're up and running, those same lines that print gravure cartons for the likes of BAT can actually print high-quality labels for Heineken, or they can do the toothpaste tube boxes for Colgate and emboss them and do all the right stuff. So we then just broaden the range, and we start doing metals and closures and crates and everything else. So in Nigeria, for example, we've now got 3 factories, which we started at 1, and now we're doing all these other things, introducing closures and things like that. But obviously, it's a fairly low-risk model, because effectively, we don't go in until we've signed the long-term contract. So we've taken the commercial risk away. And I always, when I get asked about the risks in Africa, I argue that a lot of the business risks are lower there, because we don't have labor problems. I mean, I cannot recall a single labor strike in my 5 years at Nampak anywhere in Africa. I cannot recall a month in South Africa when we haven't had labor problems. So it's, you don't have that dynamic to contend with. And then, of course, your volumes are growing and your margins are not under pressure. So your client base is growing, and his focus is on give me more. So we've run out of capacity in Angola. Our beverage cans, we put in a line, commissioned 2 years ago, doing 20 million cans a month. It's now doing 70 million cans a month, and we can't cope, hence the new capacity. When your client cannot get enough cans, the last thing on his mind is, I want a better price. It's just give me the damn cans. We'll worry about the price next year. And that's the dynamic. So for us, it's a huge opportunity. And I argue that there are risks in Africa, infrastructure, political. But from a pure business perspective, we do not find it that difficult operating in Africa. We find we're used to running there, we're used to operating there. Sales are growing fantastically, margins are much healthier, and the sort of key risks for business people in terms of sales, margins, labor are much lower there than here in South Africa. Just a slide to give you a sense of what we do in the different countries. So if you look at Zambia there at the bottom, you'll see that Nampak is manufacturing most of our products in Zambia because we've been there quite a long time, and we've grown there to doing crates and closures and a whole range of products. If you look at Angola, where we're pretty new, or Ethiopia, you'll see that just one or two crosses on that line, but clearly that's the opportunity. We really do expect in each of these countries to roll out all the others. So what we do is we create mini Nampaks, and again, for any of the accountants present, you'd recognize that we're now spreading those management overheads and the rentals and everything over a much broader spread of products and sales, so your unit costs are reduced. So it makes a lot of sense as well. And that gives you a sense of how our trading profit from Africa has grown in the last few years. So it's phenomenal growth. But I think this slide is kind of illustrative. Those other companies that are showing there, that's the operating profit. Those are our packaging competitors in South Africa. Those are their total group profits. And you would know that the last few years, those profits haven't done much. But just to give you a sense, in 2011, this is just our operating profit from Africa over here. But you can see where we were. So in other words, we've got this 500 million profit coming out of Africa, and most of our competitors are fighting down below this 100 million rand a year operating profit. And you know in South Africa there ain't going to be much growth. If you get 1 or 2% growth this year, you'll be lucky, and there's pressure on your margins. Each of those companies has seen reduced margins in the last few years. So it's really a significant amount, and clearly we will be really disappointed if we don't go past the remaining guy there this coming year. And that's his total group profit, not. So just put into perspective how significant Africa is.